Good morning, everyone, and welcome to your Monday morning market brief. So US markets had one of their biggest one-day declines in a couple of years now after Jerome Powell, who was in Jackson Hole, spoke very aggressively about the ongoing interest rate environment in the United States. He wants to get inflation down. I'm going to read to you some of the words that he used with respect to his address to the press on Friday. More direct, forcefully, sustained period, pain, far greater pain, particularly out of balance, restrictive. These were words that central bankers generally don't use. The market was surprised by that. But here's the thing. US markets might have been down, but the bond market leads the stock market. And the bond market did not move. And therefore, I believe a lot of the volume that was created on Friday, the advances decliners line was 6-1, meaning for every one stock that was rising, six were falling. Algorithms inside investment banks and hedge funds would have been triggering like there's no tomorrow, driving this momentum lower on Friday. The bond market did not move. If the market was worried about interest rates going higher in the US in a recession, I can assure you the bond market would have been moving higher. The 10-year Treasury yield would have spiked by 0.25% or more, didn't move. It was dead flat. So I think Friday's sell-off was a once-off overreaction move that I think that ultimately will prove that things are not as bad as what a lot of people suggest with respect to an impending recession. However, there's a couple of seasonal things I want you to know about. Seasonality and historical evidence is big in financial markets. September, historically, is the worst month of the year for the share market. However, from October through until the end of April is the best period of the time for the share market. And that has been proven recently by some posts I've put on Facebook and some historical evidence that goes back 100 years with respect to what the market does. If you're someone right now that's thinking, I'll just sit on the sidelines and wait till prices go up, you are someone who's going to miss the ripping rallies that will likely occur in the coming months, and you cannot afford to start to put your money into the market after it starts to move higher. Get invested, stay invested, and continue to invest in great quality, high-producing, dollar-producing assets, and you'll do just fine. Have a great Monday. See you tomorrow.